A sleep well at night investment is often a term used in the world of finance to describe an investment that is considered safe or low risk and unlikely to cause significant anxiety or stress for an investor. In the context of stocks or ETFs, of course, a sleep well at night investment typically refers to a security that is perceived as stable and less volatile compared to riskier investments. And now, although all investors are free to have their very own risk profile, I personally tend to lean closer to the safer investment vehicles for the majority of my portfolio and then have smaller, more satellite positions that might be a little bit more risky. Now in this video, we are going to go through 3 ETFs that in my opinion are very much so sleep well at night investments. We're going to also dig into each one of these ETFs and show you why it could be a perfect long-term investment for the investors that aren't looking to stress day in and day out through market volatility. Now stick around, drop a like down below, and let's get into the first ETF. Now the first sleep well at night ETF that is one of my favorites is ticker symbol VIG, the Vanguard Dividend Appreciation ETF. Now VIG has a very simple summary. It says seek to track the performance of the S&P US Dividend Grower Index, passively managed, remains fully invested, and emphasizes stocks with a record of growing their dividends year over year. And if you've seen any of my videos before, you know how much I love dividend growth. Now VIG has a very cheap expense ratio of just 0.06%, which makes this ETF quite cheap to hold on to long term, which I also like. VIG is one of the largest ETFs as far as assets under management at $66.15 billion. Now VIG's performance speaks for itself. It's up around 210+% on the all-time chart, and that's not even including dividends. And speaking of dividends, VIG does pay around a 2% starting yield, with massive dividend growth of around 9.9% over the last year, 12.3% over the last 3 years, 9.5% over the last 5, and 7.8% over the last 10. So even though VIG's starting dividend yield of around 2% might not seem that massive compared to other ETFs across the market, the dividend growth is definitely there. This ETF is most likely going to continue to pay more and more to you as the quarters go on, and that's because of the holding makeup that it chooses. Now, speaking of holding makeup, technology makes up the majority of this ETF, which I love because that does give this ETF a little bit more growth potential. Financials is the next biggest position, healthcare after that, industrials after that, consumer defensive, consumer cyclicals at 7%, basic material, energy, utilities, and communication are all under 5%. Now, the top 10 holdings make this ETF, in my opinion, a very much so sleep well at night ETF. We got companies like Microsoft leading the way at almost 5% of the ETF. Then we have Apple at 4.5%, we have ExxonMobil, United Health Group, JP Morgan Chase, Johnson & Johnson, Visa, Broadcom, Procter & Gamble, MasterCard, and 318 different holdings make up this portfolio of the ETF and all, which makes the ETF very diversified. So even if, say, 1, 2, 3, 4, or 10 of the different stocks within this ETF are performing horribly, let's say, the rest of the stocks should most likely pick up the slack, and this ETF, in my opinion, is an ETF you don't even need to check on all that often. Now, the next ETF that is a sleep well at night ETF, in my opinion, and my largest current ETF holding personally, is the SCHD ETF or the Schwab US Dividend Equity ETF. SCHD tracks as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index, which is the index made up of dividend-paying stocks that also have a history of raising their dividends pretty consistently. Now, SCHD is also very, very low total expense ratio, the same of VIG at 0.06%. And very much so like VIG, SCHD has also had some massive growth over the last 10-12 years, up around 167%, not including dividends. SCHD is also very large at $46.8 billion in assets under management. Now, one of my favorite things about SCHD is the dividend, of course, because although this ETF does have some massive growth potential and has grown quite a bit, the starting dividend yield of around 3.7 or even close to 4% is very, very nice. The dividend growth is also there at 5.7% over the last year, 11.44% over the last 3 years, and 13.69% over the last 5, 11.11% over the last 10. So just like VIG, over pretty much any time frame, SCHD has raised their dividends pretty consistently year over year and will hopefully most likely continue to do so in the future. Now, as far as the SCHD ETF's holding breakdown, I would say personally I like VIG's better, although these stocks do offer a little bit more dividend. When it comes to SCHD, industrials is leading the way at almost 18%, then healthcare, financials, consumer defensive, technology is only 12%. Then we got energy and consumer cyclical around 10%, communication, basic material, and utilities all under 5%. Now, these top 10 holdings might not be my favorite stocks across the entire market, but they are for the most part good sleep well at night stocks. We got stocks like Amgen, abbvie, Chevron, Pfizer, Pepsi, Merck, Broadcom, Texas Instrument, Coca-Cola, and Cisco. And now, like I did say a second ago, I personally probably would pick VIG's top 10 holdings over SCHD's, but I think regardless, both will do pretty well long term. Now, SCHD only has around 100 different holdings, which means this is not going to be as diversified as that of VIG, for example, although 100 different holdings is definitely going to give you a nice diversified portfolio, especially if you're comparing it to single stock picking. Now, my next favorite, Sleep Well at Night ETF, which I hold a ton of, is ticker symbol DIVO or DIVO, or the Amplify Enhanced Dividend Income ETF. Now, if you've never heard of DIVO, listen in. It says income potential, comprised of high quality dividend oriented stocks along with a covered call strategy on individual stocks. So not only does DIVO invest in high quality dividend paying stocks, but also they use a covered call strategy in order to earn even more income in the form of premium for the investors. Also, DIVO seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So in a situation where the entire market might be selling off like crazy, DIVO, for example, most of the time is going to have a much less movement, much less beta, which is perfect for more of a conservative income-focused investor like myself. Looking a little bit deeper into the DIVO selection methodology, it says dividend growers. DIVO is managed with a strong emphasis on owning high-quality large-cap companies with not only historical dividends, but also earnings growth. Sector allocation, DIVO is relatively balanced among the traditional 10 S&P sectors, with CWP determining which sectors to over and underweight based on various factors, which of course can be changed over time. Also, security selection. DIVO consists of 20 to 25 stocks, which are screened and adjusted accordingly according to attributes including market cap, management track record, earnings, cash flow, and lastly, maybe my favorite aspect of this entire fund, covered call options are written on individual stocks on a tactical basis, not an index approach. Now, because DIVO does offer a much larger starting dividend yield and it hasn't been around all that long, this ETF is not up as much as far as total price return, but still has grown over time. Also important to note, DIVO has a 0.55% expense ratio, which is because it's actively managed, so you are going to have to pay a little bit more for that. DIVO has $2.87 billion in assets under management, making it the smallest out of all three. But one of my favorite parts about DIVO is the dividend, of course. It offers almost a 5% dividend yield, and although DIVO doesn't necessarily offer any dividend growth, it does pay a consistent around 15 to 14 cents on a monthly basis. Yes, monthly basis. And it's been paying it consistently for many, many years now. Now, as far as DIVO's holdings, we have some short-term bonds. We got United Health Group, Visa, Chevron, Microsoft, Procter & Gamble, Apple, JP Morgan, McDonald's, Goldman Sachs, and 36 different holdings make up this ETF in total. Now, even though DIVO isn't as diversified because, of course, the fact that it uses the covered call strategy overlay, it does help with some potential downside and some volatility. And honestly, the breakdown is pretty diversified when it comes to DIVO. So for the investors out there that do favor some more cash flow on a consistent basis right from the start, DIVO is going to definitely do so. DIVO is going to pay you quite a bit in the form of dividends on a monthly basis. And even though there isn't necessarily as much dividend growth, DIVO is going to pay around a 5% consistent dividend with some growth potential in the ETF price over the long term. So there we have it. Those are 3 Sleep Well at Night ETFs that I personally hold in my portfolio. Now, out of VIG, SCHD, and DIVO, for me personally, I currently own and hold the most SCHD and DIVO, and this is because for my personal investing strategy, I typically tend to favor more cash flow on a consistent basis. Now, that of course does not mean that my investing strategy is necessarily right or wrong, and the great thing about the stock market is you can invest into whatever investment vehicle works best for you. But when it comes to good high quality Sleep Well at Night ETFs, I want you guys to comment down below some tickers in the comments, and let me know which one is your favorite of all. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.